Hi, everyone, and thank you for joining us for the status and landscape of the passage of the Tax Cuts Jobs Act 2.0 within the process of budget reconciliation, as well as budget resolution, which we'll speak to today. My name is Ron Wainwright, and I am a partner at Cherry Bekaert. And on behalf of Brian Moore, our managing partner of tax, we welcome you to our webinar. In this webinar, we will gain important insights on the current status of the budget resolution, Congress's position on tax policy, and how the House and Senate committees are moving forward with the agreed budget plan and reconciliation process. I'm also pleased to have my fellow partners with me today, and Mark Arrigo, Mike Kirkman, and Martin Martinez. So we have a lot of information to cover today, so let's get started. From a tax policy perspective in 2025, we want to go through really where is the state of play. So just to lay some groundwork, we know that President Trump's tax plans specifically are to make the expiring individual income tax cuts from his 2017 Tax Cuts and Jobs Act permanent. There's also a number of pro-growth provisions within the 2017 Tax Cuts Jobs Act that he's very much focused on, specifically the qualified business income deduction 199 Cap A, the interest expense limitations under 163J, and then, of course, bonus depreciation. A discussion that will be had by both Mark as well as Martin is really the SALT cap. And what does that mean? That is a very hot topic, if you will. We know that President Trump also has plans, at least from a campaign perspective, to exempt Social Security benefits from taxation and exempt tips from taxation, as well as exempt overtime pay from taxation. We do not have time today to talk about the tariffs and trade update, but as a high level, here is where we stand. So Trump orders an across-the-border 10% tariff hike. That baseline 10% took effect at 12:01 on April 5th. Additional country tariffs ties to trade deficits, and those were announced, and those have gone into effect at 12:01 a.m. this morning, today on April 9th. So that's kind of the groundwork of what we're looking at around President Trump tax plans. So let's now talk about the state of play. Next slide. So where we are is really in what is referred to as the budget resolution process. Remember, it's a two-step process before we can ultimately get to a tax piece of legislation. Budget resolution is first, then budget reconciliation, which we'll speak to, and then ultimately a piece of tax legislation to be signed by the president in regards to, as I stated, Tax Cuts Jobs Act 2017, making that permanent, or really what's now referred to as TCJA 2.0. So where are we? On April 5th, the Senate approved changes to the fiscal year 2025 budget resolution called Congress Resolution 14. It was a 51-48 vote. You can determine quickly that there is obviously not a lot of bipartisanship support here, but really more of a straight party vote. There were two individuals that did vote no on the Republican side of the aisle, and Senator Collins as well as Senator Paul, who voted, of course, with the Democrats, not from a Republican standpoint. So you begin to see some small fracture, if you will. The House had initially passed this resolution as a reminder in late February. So Senate picks it up in April, and the amendments retained the reconciliation instructions for House committees tasked while developing tax and spending measures on the Senate side. So in essence, what's happened is the Senate added its own set of budget reconciliation instructions, which I'll highlight later in the presentation. Next slide. So when we think about where the House is, the House may vote, and in fact, the Rules Committee is meeting at 8:45, or now in process, to really vote on their House side, if you will, which would ultimately take the resolution to the floor potentially today. Now, that'll be an interesting event because we know that on the House side, the Freedom Caucus has opposed on the Republican side the resolution on the House side. So that is chaired by Andy Harris, a Republican out of Maryland, and he has 7 other House representatives that also are in line with him to vote no on potentially a House resolution. Again, the Rules Committee meets at 8:45, and that rule vote will give us the first indication. So again, the House may vote on the Senate's proposed amendment towards the 2025 budget resolution, but I would say they have to do it by April 11th because then they begin a 2-week recess. So the House Republicans have circulated a Dear Colleague letter encouraging members to support the amended resolution so that the House and the Senate, in essence, can be aligned. But again, they have different budget reconciliation instructions. Remember that the resolution does not need the president's approval. However, there was a GOP fundraising event last night, black tie, on the GOP side, and President Trump, and it made national television, did in fact push forward on the GOP side of the House to basically indicate, let's get this moving. We need to get a budget reconciliation. We need, from an American taxpayer perspective, to ensure that the Tax Cuts Jobs Act of 2017 is in fact made permanent. Remember that budget reconciliation allows legislation to pass in the Senate with a simple majority, thereby bypassing the usual 60-vote requirement. That is very, very important on the GOP side. So let's talk quickly about the budget resolution framework and some key differences that we're seeing in the instructions. As I mentioned, the Senate has instructions, the House has instructions. They've kind of diverted. Not the first time this has occurred, but definitely different instructions to the respective committees. So on the Senate side, the amendment budget resolution permits the Senate Finance Committee to basically create legislation for a net tax reduction of $1.5 trillion over a decade. Now, that is what is referred to as the current policy baseline. Very important when you compare that to the current law baseline, which we'll talk about in a few minutes, and how ultimately it gets scored. So the Senate amendments introduce new reconciliation instructions, as I've mentioned, concerning funding for border security, defense spending, and domestic energy production. There is a minimum of a $4 billion mandatory spending cut, and it's required across 4 very specific committees. Ultimately, the amendment on the Senate side suggests increasing the debt limit by $5 trillion. So let's compare that to what we see on the House side. So, well, before that, let's go to current policy baseline. So that ultimately is a parliamentarian decision, and the Senate leadership has been informed that the Senate parliamentarian is likely to allow the Republicans to use a current policy baseline versus the traditional current law baseline in their reconciliation. This is a first in Congress, if you will. This approach is the only way that the GOP side can ensure that the existing provisions of the Tax Cuts and Jobs Act do not expire, i.e. that, quote, 51 vote on the Senate side. Baselines, as a reminder, are utilized to estimate the financial impact of tax legislation. So typically, what is referred to as the current baseline is used. It's comparing the cost of proposal against existing law, including any expiring provisions. So when we think that's the current law baseline, the current policy baseline assumes the continuation of existing policies without assigning them any cost, even though they are set to expire during the reconciliation process. So a very significant difference. Last evening, there was a group of senators that were interviewed on national television, and Senator Graham, who heads, in essence, the Budget Committee, indicated that that was his decision in the Senate and not the parliamentarian decision. So there's still some tension there on the Senate side that we'll pay close attention to. Next slide. So when we think about the Senate resolution and the current policy baseline, just to kind of put a sharp pencil on this, or point on this, is that the Senate use of a current policy baseline would basically assume away the roughly $3.8 trillion cost of extending the TCJA tax provisions within the 2025 or the 2034 period, in essence, the 10-year period covered by the resolution. But the more significant effect is that a current policy baseline would also zero out for reconciliation scoring purposes only the deficit's effect of current policy in future decades. So that 3.8 trillion that I mentioned. So what does this mean? The Senate will be able to make expiring tax credit provisions permanent without the sunset provisions that were in essence required in the 2017 TCJA, in essence 1.0. The TCJA sunsets were necessary at that time to, in essence, comply with the Senate rules that prohibited a budget reconciliation measure from increasing federal deficits in future decades. So this current policy baseline versus current tax law baseline is very important to pay attention to. I do not believe the Senate would have passed it under Senator Thune or Senator Graham, as well as others, that they didn't feel, based on meetings that they've had with the parliamentarian, that they would ultimately see a current policy baseline, but to be determined still. So when we think about budget resolution, key differences on the House side, their amended resolution keeps the House-approved reconciliation instructions, requiring the Ways and Means Committee to, in essence, authorize net tax cuts of 4.5 trillion over 10 years. In essence, using a current law baseline, again, a comparison to current policy baseline versus current law baseline. Other House committees are instructed by the budget resolution to cut mandatory spending by at least 1.5 trillion. And the full 4.5 trillion on the House side in net tax cuts is very dependent on Congress reaching a much higher target of 2 trillion in mandatory spending reductions. And the president spoke about that last night openly towards the House side and those members of the Freedom Caucus, as well as deficit hawks, where he said we will in fact have spending reductions. And he didn't commit, but he indicated that obviously the spending reductions are very important. So the House budget resolution also suggests, as an FYI, raising the current statutory federal debt limit from 36 trillion by an additional 4 trillion. Next slide. So here's a comparison. We're not going to go through this in detail, but I would encourage you, because we have a lot of good information to talk about, to really dive into this from a comparison of the budget resolutions. The key is around the debt ceiling, increases the debt ceiling by 4 trillion, as I've mentioned on the House side, where the Senate utilizes a current policy baseline. Therefore, that 3.8 trillion doesn't get scored in it. And that's where I have the comment, the baseline on the Senate side is still to be determined based on the parliamentarian decision. Other items, increased defense spending by 100 billion and Homeland Security by 90 billion on the House side, where the Senate says increased defense spending by 150 billion and Homeland Security by 175 billion. So you can begin to see there's going to be a number of real levers that have to be pulled, specifically on revenue raisers as well as spending cuts. Next slide. So here's some, next slide. Lingering concerns and questions when you think about the comparison of the House plan and the Senate plan. While both the House and the Senate have in essence the same budget framework, many of the difficult policy decisions as we are in a state of play today have yet to be addressed. There is massive variances in the chambers, the upper house and the Senate, and the lower house, obviously being the House of Representatives, reveal these disparate visions as I've outlined here in the slide. Tax cuts, 4.5 trillion in total tax cuts on the Senate side approaches zero. So there it goes back to that, law versus policy baseline. Spending cuts, floor of 1.5 trillion, but 2 trillion really required to unlock that 4.5 trillion total for tax cuts on the House side. Again, debt limit increase 4 trillion, Senate 5 trillion, and you can look at the spending cuts. So a lot of horse trading and negotiations still to occur. Next slide. So let's kind of talk about some observations that we have, or general observations. So deficit hawks. Those are members who are very focused on keeping the federal budget under control. They are concerned about the lack of required cuts in the Senate instructions in reconciliation. Congressional leaders, as I mentioned, with the assistance of President Trump, has certainly persuaded skeptical members to vote for the budget resolution by emphasizing they were not voting for policy, but to start the drafting process, and by promising to support efforts to significantly reduce the deficit. And that has, in fact, occurred on the GOP side. Meanwhile, some more moderate members remain apprehensive of the level of cuts required by the House instructions. And several policymakers have voiced concern over the potential reduction in Medicaid benefits. And so those are kind of some key spending cut observations. Next slide. So when we think about tax cuts, so remember we have spending cuts, we have tax cuts. And by the way, this kind of brings us up to a polling question. How did you hear about the webinar? A Cherry Bekaert tax advisor, email from Cherry Bekaert, friend of a colleague, Cherry Bekaert alumni, or social media post? All right, let's go ahead and close the poll. And we'll see the results. We're hoping an email from Cherry Bekaert or one of our tax advisors. So good. Email from Cherry Bekaert. Excellent. So here's some tax cut observations at a very high level. And Mark and Martin will do a good job in really explaining some of the SALT caucus and the bipartisanship there and what it could mean from a SALT cap increase and or an expansion of what is in the Tax Cut Jobs Act. Depending on how that change is ultimately structured, it could cost anywhere, when we think about the scoring, of $100 billion to over $1 trillion. $1 trillion would ultimately be eliminating the current $10,000 cap. Next slide, please. So some other observations. Some House Republicans have clearly noted their unease in using the current policy baseline. Again, it would be the first time in history that this had occurred. Several do not seem to support the overall strategy, while a few others have noted strong concerns about proceeding without any indication from the Senate parliamentarian, though, again, Senator Graham in national with other colleagues last night in a national interview indicated that he felt it was his decision and he's got a good relationship with the Senate parliamentarian, but still to be determined. Again, utilizing this novel strategy does inject a level of risk in this process. So, in the event that you would potentially rule against them, don't know if that's likely or unlikely, but should the Republicans get to the end of the line and lose a point of order over the current policy baseline, they'll be in an extremely problematic situation. They can overrule the parliamentarian, just to be clear, and essentially suspend the filibuster. But several Republican senators have also publicly against that strategy. And the parliamentarian's been there quite a long time. But she's had the appropriate meetings, and but to date has not made any decisions. So let's all remember that the Republicans also have a diverse conference. As I mentioned, the House Freedom Caucus has come out, which again is chaired by Andy Harris. And those 8 have said that on the, if it goes to the floor today on the House resolution side, that they may, basically vote no, and therefore with the slim majority that occurs. Remember that when we saw 2017, 13 House Republicans voted against the TCJA, and currently Speaker Johnson has that 220 to 213 majority, meaning in essence he can't lose more than 3. If the Freedom Caucus stands, absent other additional discussions or agreements that have been made either in last evening or this morning, obviously he can't achieve that. And reminder, there's currently two open seats in the House, and unfortunately both of those members deceased in March of 25, but both of those are Democratic seats. Next slide. Next slide. So let's talk about the speculation and contents of the reconciliation bill. And so since toward the 2024 election, speculation obviously has run rampant. So we'll try and comment on what we expect that we'll see increase over the coming weeks in regards to what we see in budget reconciliation. And so we're going to give you some comments here that we provide, some items that seem to have traction on Capitol Hill, but I want to urge our clients and members of the webinar to remember that reconciliation can be a long and arduous process, a lot of horse trading behind closed doors that will likely have many twists and turns along the way. So let's talk about the revenue raisers. Next slide. So here's some potential revenue raisers. So when you think about the resolution and what they need to do, you've got revenue raisers, you have spending cuts, as I highlighted in the slide. So clearly, President Trump has voiced his support for ending the treatment of carried interest and repealing tax incentives for owners of sports teams. Remember, carried interest gives capital gain treatment, and he has basically voiced support for ending that treatment, going back to ordinary income that has been there for a number of years. And then, of course, the tax incentives for very wealthy individuals who are owners of sport teams. It's very clear the Republicans would like to repeal many of the Inflation Reduction Act incentives. If they were to repeal everything, it's about $858 billion. I'm not sure that will occur because obviously there's significant bipartisanship support from an energy side, if you will. There has been discussion among the Republicans of instituting a limitation on corporate SALT deductions, and Mark and Martin will talk about that. However, most recently, I would tell you that Bloomberg scooped the Republicans where they were considering increasing a new top tax rate for millionaires upwards of 40%, up from the current 37%. So that could be a revenue raiser that we see. And ultimately, they could dust off language from 2004 and that bipartisan bill that failed to advance in the Senate, which basically, basically retroactively ending employee retention credit as of January 1 of 2024. Next slide. So when we think about the spending cuts here, or reconciliation of tax cuts, the Republicans are generally aligned in their desire to extend the TCJA provisions. Senator Thune noted he is planning to use part of the additional $1.5 trillion provided in the Senate to reinstate domestic R&E expensing, or what would be 174, the use of EBITDA and the business interest limitation calculation, and bonus depreciation, often referred to as the pro-growth provisions. That's a focus, at least on the Senate and also the House side or the GOP side. And then, of course, President Trump, as I said, is likely to eliminate tips on overtime and tips income, as well as Social Security. But that's, again, cost. Republicans have been, as I mentioned, discussing actually the child tax credit recently, and potentially expanding it, but at much lower levels and in a very finite area. Senator Thune is in favor of full repeal of the estate tax. Mike Kirkman will address that. And then ultimately, Senate Finance Committee Chair Mike Crapo out of Idaho, he has received 200 plus ideas from his fellow members about reconciliation tax cuts. So Senator Crapo has noted that he is in favor of changes to low-income housing tax credit. So you can see there's a lot at play here. Next slide. So what's the path forward? And we're going to go through this very quickly. If we could just get to the slide on moving forward around the timeline and what actually happens in budget reconciliation. Next slide. So this is where we're at. We're in green. Budget resolution is passed. Actually, it has not. So again, both the House and Senate passed, in theory, an identical budget resolution outlining spending and revenue targets. So we'll see what happens in the Rules Committee, as well as we'll see what happens on the House floor today. Then you go to committee drafting bills, where again, you've got an area draft, and we've already said there are divergent there in regards to the instructions. Ultimately, the budgets committees comply both on the Senate and the House side. You get a floor vote, then you go into conference committee, and then ultimately the president's signature. That is a arduous process with lots of twists and turns. But again, you got to get budget resolution first, then you get in the reconciliation process. So still a lot to be done. And we'll try and give you a timeline here. Next slide. So there's a lot of remaining questions: spending cuts, tax cuts, TCJA tweaks, 3 business provisions, which I've identified, and revenue raisers. And so there's questions in each one of these categories around, the reconciliation. Again, an arduous as well as a lot of twists and turns before we may see a piece of tax legislation or TCJA 2.0. Next slide. There you go. So here's observations. The potential opposition to different revenue-raising offsets are likely going to impact the House and Senate's ability to pass a final bill solely with Republican support, given, as I've identified, the narrow margins in both chambers. Disagreements have already occurred over the extent of mandatory spending cuts. Those also could pose a significant challenge as reconciliation legislation moves forward in each chamber. Again, I've already mentioned the deficit hawks in the House and the Senate, as well as the Freedom Caucus on the House side. Other Republicans in Congress are worried about the potential impact of large spending reductions on their constituents, obviously, in those midterm elections. That was part of that, I believe, fundraiser last night. Next slide. So here's the potential timeline of here. The authority for budget reconciliation ultimately has to be done by September 30th, as that's when the resolution expires, because obviously the current fiscal year end of the federal government. Speaker Johnson has continued to say he wants a final bill to President Trump before the Memorial Day recess at the end of May. I think that's very unlikely. I think we're thinking more in, potentially on a best case scenario before the July 4th break, but likely, as I comment here, certainly before they ultimately break from an August standpoint. And so most Senate leaders, as well as House, have said 6 to 8 weeks. Next slide. Final observations here, just to round it up. So the inclusion of the debt limit increase, I think, does help. It could and will speed up the timeline for completing the budget reconciliation legislation, i.e. that September 30th date. So they're going to get something done before they recess in the August timetable for 2 months. If the debt limit is not raised, ultimately the Congressional Budget Office has got some challenges, and they're going to have to use extraordinary measures for borrowing, and that'll likely be deleted by that August or September timetable. That's why I think, conservatively, that's the path we're on. So therefore, Congress will probably need to pass a reconciliation bill that includes that increase in the statutory debt limit, $4 trillion, $5 trillion, as we had in one of our other slides. Next slide. I'm going to turn it over to Martin Martinez, one of my colleagues now, to talk about the corporate tax. But before that, we're going to do a polling question. Has your organization begun planning for not only tariff, but also the TCJA 2.0 implications? Yes, somewhat, no. We'll hold that poll open and then we'll get to Martin. All right, let's post those results. We post those results. All right. Again, somewhat waiting to see what happens. We would encourage you to certainly reach out to Cherry Bekaert, but begin to plan now for August. There's a lot to plan around, specifically the tariffs side, as well as certainly on the Tax Cuts Jobs Act 2017 2.0. So I'm going to turn it over to my colleague Martin now.
Thank you, Ron. Good morning, everyone. My name is Martin Martinez. I'm a tax partner with Cherry Bekaert, and actually I'm the corporate tax leader. As Ron was going through his analysis, some of the things that we're looking at that are definitely going to affect business entities with respect to the expiring tax credit, the expiring provisions of the TCJA, looking at the impact, this should say increase to the BEAT tax rate. The BEAT rate currently is effectively could increase from 10% to 12.5% for businesses that are impacted by this provision. The deduction for GILTI under the 250A3B relevant change percentage could be reduced from 50% to 37%. The significance of these changes is the fact that with respect to GILTI, these are permanent adjustments with respect to your provision. It'll have an impact on your effective tax rate and cash flows. Looking at bonus depreciation, even though it is a pro-business incentive, it definitely has the potential to, how do you replace the pay for with respect to increasing bonus depreciation and where you're going to be able to pull the money from the revenue raiser standpoint. The qualified business income deduction could be significant for the entities that this affects. And then the limitation on excess business losses for non-corporate taxpayers, S corporations with flow-throughs, partnerships. This definitely has impact to those individuals with respect to the individuals that they're ultimately going to affect. The FDII deduction changes. The deductibility of meals provided on the premises at the convenience of the employer for, significant companies, companies that have, large employee bases. This is a nice benefit to be able to have, but it'll definitely have negative or adverse impact with respect to the deductibility. And then for those in the real estate space, election for special rules for capital gains invested in opportunity zones. The policy issues that we're going to be dealing with is pretty much the sticker shock with respect to the extensions. The SALT cap shakeup Mark is going to go into and the effect on the pass-through entity tax regime. One area that I find interesting is the tax and climate clawbacks. As Ron alluded to, the energy credits have bipartisan support from both the Republicans have their ideas with respect to how the advanced manufacturing production credit is working, but in effect, the ability to be able to buy tax credits on the portal has been quite beneficial to the industry. And again, I think from an energy from all sources standpoint, with respect to the clawback provisions, I think you're going to end up looking at, or at least there seems to be significant traction on the repeal of the EV $7,500 bet credit that's available. That seems to be the area that they're going to be targeting, but it's certainly going to be a targeted approach more than just a complete overhaul. And again, on the tariffs and tips issues, global supply chains are definitely going to be impacted. And, one of the things to look out for is that to the extent that there's going to be increases in costs, looking at, workforce reduction, et cetera, is something to keep your eye on. So how do you pay for all of this? And this is the biggest issue. Bonus depreciation, I think, is pro-business and pro-growth as that provision gives you, and everybody enjoys the benefit of that timing deduction. That's one of the areas that we're looking at and modeling with our clients. The 163J business interest deduction, again, to the extent that there's any ability to change that rule would be quite beneficial, but the carry forward of those suspended losses is significant to the businesses. And then for those of us in the provision worlds where you're having to do your annual reports, your filings of 10Ks and your quarters, the analysis and the continued valuation of your deferred tax assets become significant. And again, in my opinion, the section 174 research and development expensing is going to be an area in which it's been stalled. They've been trying to adjust this and remedy this situation for the unforeseen consequences that have occurred. But 174, in my opinion, may be here to stay unless they're going to be able to find a way in which to revenue neutral the effect of changing this. And again, I think the Inflation Reduction Act, another area which is a great benefit for many companies, especially in the corporate tax world, is a nice area that you're able to take at least a small benefit with respect to being able to obtain these credits. And then as I was going through my analysis, one of the things that comes up is, well, where else do we find this? Well, all the tax breaks and the codes, and I think as Ron alluded to, is that the raising the individual tax rate on high wealth individuals is going to be an area in which may be looked at as a way in which to gain a revenue raiser. So sunsetting the tax cuts impacted businesses. At least in my opinion, I think there's going to be congressional pressure to use the business tax policies to prevent tax hikes on individuals and to reduce the overall cost of this forthcoming tax package. There is a high likelihood that future tax legislation will contain several adverse tax policy changes for businesses, including new revenue-raising measures. So businesses should begin identifying expired and sunsetting provisions of the federal code that most affect their business model. And the way we've done this is we've taken for our public entities and even for our non-public entities, private companies, taking a look at their tax provisions, looking at the tax provisions, and what we're doing is building, an assumptions page, triggering in the items that are most significant to their business, for high tech and pharma, looking at the effect of 174 and how that impacts their tax provision, current taxes, deferred taxes as they roll out, and then looking at the effect of the, cash flows. That's where we're spending a significant amount of time. Again, I believe the most important thing in this time of uncertainty is to develop some proactive mitigation strategies. What affects your businesses the most? If you're a multinational company dealing with operations in multiple foreign jurisdictions, I would say that any change in the GILTI calculation and the FDII calculation will have a significant impact on companies' businesses. Again, I think Section 174, at least in my opinion, has been the most significant issue affecting businesses adversely. I believe most businesses have been able to at least structure and plan around this issue at this point and how this would roll out. And I know that there was discussion of retroactive application of Section 174. However, the way that the statute is written, at least currently, is that those suspended or carry forward the costs are not really expenses. And so how they would roll that out and able to make that revenue neutral is going to be interesting. But even if it was on a prospective basis, significant benefits. So again, putting together effective models that have different assumptions input so that you can effectively and quickly analyze what a potential change could be with respect to your corporate tax rate, corporate effective tax rate rather, and cash flows is just critical in being able to be nimble and how you may be able to change your business model. Now, for multinational companies, to the extent there's going to be changes in the tariffs and how the tariffs may impact you, that is going to be a significant issue. And I believe we'll be having a separate webinar on that with our international tax team. But the supply chains increases the costs, how that affects your business model, reductions in revenues with respect to those changes, and ultimately reductions in net income and operating income could be significant. So what we're trying to do now is work with our clients to put together effective models so that we're able to advise them on the best path forward in which to make the most business sense and how these different expiring and changing provisions could impact their businesses. So with that, I'm going to go ahead and turn this over to Mark to go through everybody's favorite topic, the SALT cap. Before we do that, let's do another polling question. Is your organization proactively strategizing to navigate potential corporate tax changes? Yes, we have begun to set up a plan. We have had discussions, but not putting together a plan. Not sure. No, waiting to see what happens.
Hey, Martin, while this is open, why don't you can leave it open. I'll go ahead and start a little bit on the SALT piece, just to set the stage and kind of walk through this. So I'm Mark Arrigo. I'm the National Managing Partner of State and Local Tax here at Cherry Bekaert, and it's a pleasure to be here today. Never thought I'd talk as much about the SALT cap as we have been, but it's such an issue. So let's kind of level set where we are. Pre-TCJA, there was no limitation on the SALT deduction from an individual standpoint. TCJA established the $10,000 annual SALT cap. Now, let's be honest, that was a large payer for TCJA 1, so it was a revenue raiser. And bear in mind, what we're talking about is not applicable to the business taxpayers. And if you look at TCJA, it is effective from 2018 to 2025, and we've alluded to this, and it does sunset. If it sunsets, the SALT cap would come back in. It would have unlimited revert back to pre-TCJA years. and it would open up that is really something I think everyone is working to avoid. But on the flip side, I want to point out the IRS guidance. This is really important. The IRS did issue a notice 2020-75, and it was the intent to issue the notice proposed regulations to clarify the deductibility of SALT payments made through pass-through entities. Now, it's really important to note this never was finalized by the IRS. I think it was something no one wanted to touch. But this is, along with another piece, this is kind of what could be an additional revenue raiser as part of this, because there is an avenue to raise revenue still with the SALT cap relative to getting a little bit higher amount for the SALT cap, which we'll talk about in just a second. So let's move to the next slide. And this slide just reminds us, 36 states and New York City have enacted pass-through entity tax elections. So this has become very mainstream. Not to say it's not administrative burden for the states and jurisdictions, because it's an unusual manner that these are developed. But again, when you look at Notice 2020-75, what really happened prior to that, only 7 states had even enacted this. So clearly the states wanted to work around this. It has been received fairly positively, from that standpoint overall. And you can see the map, and all the blue is really all the states that have looked at this. So you take a look and you get a good sense of what's going on. So from a state standpoint, and by the way, the one key thing the states are starting to do is they're starting to actually not give you the full benefit. There are a number of states, Massachusetts and a few others, that have started taking a slice of the benefit back into their revenues. So bear that in mind as well. It's not huge percentages, but that's how the numbers work. Let's move to the next slide, because we'll kind of lay this out and where we think it's going. Currently, the SALT cap would sunset. What happens if the SALT cap sunsets? Basically, if the SALT cap sunsets, we'd go back to pre-TCJA, and it would be likely that the states would phase out or retire the PT. There are a lot of states that have enacted legislation that does not expire. There are some states that did enact legislation that would expire with changes to the SALT cap. So bear that one in mind. That's out there. Scenario 2 is it just stays where it is at $10,000. That's an interesting one. If you look at it, the state tax caucus group, with really very blue ties to them, are pushing to get that raised, and I think that's kind of on the board with where we are. So you look at that, and that's kind of where we expect. We don't expect to sit the 10,000. So let's go to scenario 3, which is probably going to become the most likely area, and we've kind of put it 20 to 50,000. I think we're hearing 25,000 is kind of the sweet spot. So how are they going to pay for this? It is a large number, as Ron alluded to. Well, the reality is the states have been using the pass-through entity tax as a way to work around the SALT cap. And Congress doesn't like it. And it legislatively, Congress could actually deal with that, because it's not how the state's done. Because remember, everything starts from a federal tax return before it goes to moves on to the states, from that standpoint. So it would be more likely that this would be allowed, Congress could look at it. Doesn't mean they will do it, but they could look at, basically technically creating some space here for a revenue raiser in how they eliminate the state's ability to do the pass-through entity taxes. So it's really important to look at that and bear in mind, there's some optics here. After you get to $25,000 as a SALT cap, you are now pushing up the salary comp, the number of people that are going to become very limited because it really benefits more wealthy people that are more involved in this area. So that's really, the optics are going to be an important piece, I think, as this comes through. Again, a lot to be determined. This is not happening, but this is where we could see revenue raisers coming out of this because they got the offset, the dollar amount that is at stake here is significant. So that's where we are on the SALT cap, and really appreciate it. I'm going to turn it over to Mike.
Right now in the federal estate tax arena, we have basically the highest exemption level that we've ever had at 13.99 million. When I started practicing in the mid 80s, it was 600,000. So you can imagine the difference. So you got a married couple, they can leave up to $28 million completely estate tax free at their deaths. The expiration of the TCJA provisions are going to expire in 2017. So next slide, please. Well, I'll continue. So at the end of 2025, basically this huge exemption that we've got, let's just say 14 million, is slated to revert back to what we think is going to be somewhere in this $7.5 million range. So that's a huge decrease in the exemption amount. And that exemption is not just death, it's lifetime gifts as well. So you've got that to deal with. Now, I'll tell you in a minute my predictions of what I think is going to happen. But what does that mean? That means a revenue raise. If we're moving from 14 million per individual U.S. citizen, U.S. resident down to 7.5 million, the tax is at a 40% rate on any assets given above or passed at death to the next generation. It's 40% tax, so that's huge. But as I'll show you in a minute, the revenue raise is not that material in the scheme of the national budget. Planning now, and we're seeing most of our clients that were fearful that the exemption was going to expire at the end of the year, they were making gifts to utilize this large exemption, and they're still doing that now. And I would really encourage everybody that's in that mode of thinking about, should I go ahead and plan to move some of the assets in my personal name to the next generation, to continue to do that strategy. So if we'll kick down a few more slides, we'll get to the potential TCJA 2.0 items that are being floated around. A couple more slides. I think it's, one more. Yeah, right there. So these are the things. Obviously, everybody in my practice area believes that we're going to have an extension of the exemption rates. But there's also been a discussion about repealing the estate tax. And just to give you some idea about the number, the cost of that is predicted to be around $370 billion. Now, that's a lot of money, but in reality, in the entire trillions and trillions of dollars of the budget, it's not that material. But it is a hot button for talks on all the media channels about the rich getting richer. There's also discussions about eliminating the date of death basis step up. So if you're familiar or not familiar with the estate tax, when someone passes, most of the assets get stepped up to fair market value as of date of death, which is a very important reset that occurs. And then the next generation, if they sell those assets, there's no capital gain on that. Well, you can imagine if they eliminated that, just imagine most of the estates in the country would not be reset. So you've got a small family that's got $1 million tract of land that they've had for multiple generations. Someone passes and it doesn't get a step up, and maybe they had low basis. So that transaction or that sale would generate a capital gain that would hit the family and also add revenue dollars to the budget. Another one that's being considered is capital gains on unrealized appreciation on assets held at date of death. This is very similar to what Canada does. And then also, this has been floated around several administrations ago as well, is the elimination of valuation discounts. We have a lot of clients that have closely held businesses, and they get valuation discounts for lack of marketability or minority interest. And so the removal of that would basically set the value at date of death at a higher value. So next slide. So what do we think is going to happen? I think that it's going to status quo, and it will probably continue on as the way we've got it with index for inflation. The current revenue raise for 2023 was around $34 billion. It's predicted, if you fast forward about 10 years, that it would be $66 billion. I think that the estate tax, any changes that's going to occur there, is always a back burner at the end of most of the negotiations in Washington. They clean up everything and then it's thrown at the last minute. But I do think we'll have an extension of the current exemption levels. All right, the last slide here is just a reiteration of what I mentioned earlier. If you're in the process or even thinking about doing planning, whether it's asset protection, moving assets to the next generation, succession planning of any type, you need to continue that because there's a lot of reasons. Even if the estate tax were repealed, there's a lot of asset protection and generational planning that still needs to happen with family wealth, even without an estate tax. But anyway, having strong advisors that understand this landscape and how to effectively move assets to the next generation is critical in all the planning. And with that, I think we're at 10:52, and we're going to our last polling question, which is, would you like a team member to reach out to you after the webinar to learn more? Hopefully everyone will say yes, and we're happy to field questions. I think our email addresses are probably in the material here, but we welcome you to reach out to us. This is a crazy time of the year for us, as most people on the call are either getting their tax returns done or getting extensions or projections made. So we appreciate you taking the time to be with us. And with that, I'll turn it back over to Ron Wainwright.
Thank you, Mike. So first of all, I want to say thank you all for attending the webinar today. In the few minutes we have left, as we always get, a number of questions, we do want to thank you for attending today. But, one question that we continue to see is to my comments around the House Freedom Caucus, or really kind of all of the things around revenue raisers and spending cuts and, the thin margins that exist, certainly budget reconciliation around the 51 votes on the Senate. It's very important. We talked about that. So let's ask the question to ourselves, what happens if today in the Rules Committee, the House doesn't pass the budget resolution? And so there's really three options, I think. I think first, they can start the reconciliation process towards tax legislation without a budget resolution. So they don't need a budget resolution to start that budget reconciliation process. On the House side, they could amend the current resolution. That is probably the unlikely outcome. So I think the outcome would be that you start the budget reconciliation process, and then you enter into formal conference negotiations as part of that quote, budget reconciliation process. So we'll stay tuned. We'll keep you abreast. We did not have a chance to talk about tariffs. I know that's front of mind. I did put a note in there in regards to the April 5th President Trump order on across the board tariffs. We had obviously this morning, April 9th at 12:01 a.m., the kind of just additional country tariff of 60 plus. The markets are obviously volatile, but the good news is that 60 plus, now upwards of 70, from what the Secretary of Treasury has indicated, have reached out. Countries have reached out to basically negotiate, which I think the current president is all about the art of the deal. So that's very positive on a number of fronts from that standpoint. So Let me just end this from the standpoint of saying the following. This concludes our webinar for today. We want to thank you again for joining. And again, if you have any questions, as Mike indicated, please reach out to us at any time. Our telephone numbers and our emails are there. We will be doing a number of other webinars, likely in the May timetable, as we begin to see more, I'll say, decisions in regards to resolution as well as reconciliation. I always want to thank my fellow partners in Mark Arrigio, who leads our SALT practice, and obviously Mike Kirkman, who leads our estate and gift practice, and Mark Martinez, who leads our corporate practice. So on that, I hope everyone has a great day. Thanks for everyone attending today.